everybody. Welcome to Chuck Yates Needs a Job, the podcast. I have now become best friends with Paul Clark, who I don't think I'd ever met before this. So, Paul, nice to meet you and welcome on.
Nice to meet you too, Chuck. Thanks very much for inviting me. It's a pleasure to be here.
So, we've never met. I think we started going back and forth on Twitter in
Yeah,
DMs over something stupid I had said. But I went to your LinkedIn page and I started reading it. And like, what in the hell do you do?
absolutely. Thanks for asking. So, by way of background, a little bit of my past. I'm from Texas. I grew up in Houston in a fictional town called the Woodlands. And I went to the University of Texas and graduated back in 2001. Between 2001 and somewhere in the mid-teens, I spent most of my life drilling wells between the Barnett and Balikpapan and everything in between. I was drilling for a consultancy, a small consultancy, and we were contracted out to people like Shell and Chevron, et cetera. So by hook and crook, I ended up taking a job with Shell overseas. And that ended up being an opportunity or an introduction to a much broader set of the global energy industry, if you like. And I ended up going from Shell to work in Geneva with a company that had assets in West Africa and in the Kurdish region of Iraq. And that company ended up getting bought by a Chinese company called Sinopec in 2009. And when that happened, I'd moved on from drilling and I was working in the portfolio team. And that portfolio team was really the introduction to me understanding how to look at things in terms of assets on a value basis, look at it on an expected value and risk adjusted and all that good kind of stuff. And when Sinopec bought us, I started scratching my head and wondering how they came up with that value. And I figured the best way to go figure out how to value companies was to go work for a bank. Whether I was right or wrong, that's another story. But I ended up working for BNP Paribas, who at the time was the biggest RBL bank in the United States, as well as the biggest RBL bank in Europe. But I was working for them out of Geneva, and we were doing structured commodity finance for companies all over the region of the world called the CIS. And the CIS is basically everything that used to be the Soviet Union, including Russia. And I did that for 5 years, and that BNP ended up shutting down that group. And there's a long history behind BNP and what happened to them. And without getting too much into the details, they got a $9 billion fine from the United States government. And that pretty much changed their risk appetite in terms of doing stuff upstream, especially in Russia and Kazakhstan and Uzbekistan. So I worked for a couple of years after that with a couple of different global markets groups and big investment banks and doing very similar activities, mostly structured commodity finance. The last place I stopped off at was a commodity trader in Zug, which is a small city in Switzerland just outside of Zurich. And that commodity trader was doing a very similar exercise. We were basically putting together structured commodity deals where we would go and do a prepayment for a whole bunch of coal or prepayment for a whole bunch of nickel to different commodity producers. And then we would sell that in the future to a commodity refiner. So we were intermediating those flows. And in 2022, that all got shut down because the owner of that commodity trader was the Russian government. And so in 2022, I lost my job because it was no longer legally tenable. The fact that they became sanctioned by the United States government made it a place where I could not work. And from a personal perspective, it wasn't something I really wanted to do anymore either, quite frankly.
Yeah.
As you can probably imagine.
Other than that, Ms. Lincoln, how was the play? I mean, gosh.
Yeah. So if you kind of follow all that, by background, I'm a petroleum engineer, but I spent the last decade and change working in a lot of different parts of the value chain, and not only on the upstream oil and gas side, but on other types of commodities. So when I came out of that, I'm an age, and I was at a level of seniority that finding a new job was pretty tough, and finding a new job in energy in Switzerland was like next to impossible. There's a couple of commodity traders over in Geneva, but they're all pretty well staffed up, and so their advice and my own my own desire was, why don't I just set up a shop and I'll look at deals. And when I see a deal that I think, man, I would invest my own money in that, I like this deal, then I'll pick up the phone and I'll call people like the traffic bureaus or the credit funds or family offices on this side of the world and see if I can't get them to follow into that deal and be a capital provider. Um, what it turns out to be is, it's a job where I do I wear multiple hats across the entire deal process. So if you think of a typical investment cycle, it's the due diligence, it's the structuring, it's the negotiation, it's the execution, and it's also the monitoring. And there's commercial aspects to it, there's technical aspects to it, but you know, shops like these credit funds and family offices over here, they're very lightly staffed. So having that third party resource is valuable to them. And it's something which has proven to be very, very interesting and a hell of a lot of fun for me. So that,
Give me an example, and it can be a made up generic example, or it can be a specific deal you worked on. But I have no idea what kind of deal you would see sitting in Geneva, Switzerland.
it's so I think taking a step back, and I'm absolutely address that, but taking a step back, if you look at what's happened to energy, and this started happening before COVID, but I think COVID just put it on steroids and really accelerated what's happened in the energy space. But the ability to access information on producing fields in North America, whether that's Canada or the lower 48, is unbelievable. It's something that's, you can log on to, and you had the guys from Well Database come on to your show. You've got outfits like that who provide data at very reasonable costs and unbelievable access with incredible quality that you can dig in and start looking at deals in the US very easily in terms of figuring out where those deals actually exist, understanding when they come to the market. That's a matter of just continuing to keep my network up in the United States. So there's a relatively good number of touch points I've got in the US who still call me up and say, hey, we've got a process that's about to launch, and we're wondering if you'd like to look at it. And so that's generally how I source deals. The same thing for deals that are coming to the market here in Europe. But the reality is the deal flow in Europe is an order of magnitude, at least less than what you see in the United States. The United States is a much more liquid market. So in terms of the deals that I'm looking at, a lot of them, and Keith from Stevens came on your show as well and talked about the family offices and their activity over here in Europe and their interest in the deals in America, and it's absolutely accurate.
Oh, interesting. So, I mean, do you have a staff, a team, and you're actually buying a property and operating it, or are you backing management teams? How do they drill down on some of these deals on what they look like?
Absolutely. So, in some, we're introduced to a management team that's existing, and they're looking for acquisition financing or they're looking for development capital. In some cases, there was a case recently in Mississippi where we were working with a management team that we've known well before they set up in Houston. We knew them. It's a management team that worked together over here on this side of the pond in a previous life. And now they've shown up in Houston, and they're all from the United States, and they've started to build an E&P company there in Houston. And so we backed them on an acquisition. And that was through the entire capital stack that was providing both equity and debt capital as a single unitranche, if you like. And then we'll look at club deals as well. If you look at some of the deals that were done in the not too distant past, deals that were like the High Peak and the Mock refinancing, we looked at those types of deals as well, where multiple credit funds come in and provide the full slug of capital, but in smaller ticket sizes.
So do you have a fund per se, or are you playing agent on these things, or somewhat of both?
So there are a couple of different funds that I'm not employed by, but I'm retained by. And those funds are fully regulated. They're well established. They have not only a track record, but they've got billions of dollars of AUM. And they either have an existing mature energy or commodity type strategy, or they're looking to build that strategy because they see the opportunity in that space.
Oh wow, pretty cool. So that's I want to go. I have ADD, and I'm sorry about it, and so it's just hitting. First and foremost, I find the Russian stuff fascinating, and here's what I'm fascinated by. And I wonder if you have an opinion on it. You know, the left in America will say that Trump is an agent of Putin. And, you know, there may or may not be a PP tape that exists.
Yeah.
I don't know if that's been fully debunked, but that's what the left says. The right will make the point that, you know, Putin took land from Bush. He took Georgia, took Crimea under Obama, and obviously has marched into Ukraine under Biden, and took no land under Trump. Do you have an opinion on who's right about that? Is Trump an agent? Is Putin actually scared of Trump? I mean, the
I, I certainly don't have an opinion, and I don't have any insight or any type of inside knowledge on the workings of the Kremlin. I can certainly say that the American foreign policy of whichever administration is in there has a significant impact, not only on Russia, but on China as well. So I worked for a Chinese bank and I worked for a Chinese refiner. Um, and both China and Russia are tremendously impacted in terms of their risk appetite by depending on which administration and depending on the foreign policies that are in place. And so I think a lot of it comes down to both the language, the rhetoric that the administration is pushing or endorsing, as well as some of the actual actions or some of the body language that suggests there's going to be an action. And that definitely changes the way that both Russia and China operate globally, and whether that's investments or the way that they're carrying out things like military exercises, as this current one is being called by the Kremlin. You know, in terms of what their incentives and what the drivers were, I think it's much more complicated than I have the wisdom or insight to be able to sort of characterize why they did what they did.
yeah. So I used to always joke that I was the greatest private equity investor anywhere Southwest Airlines flew. You know, so because it was all sort of oil field stuff. Give me a few examples of something that investing in outside the United States and or working for someone that's foreign, that sitting here in Houston, Texas, as someone that's never invested a dollar outside of Texas or Oklahoma would go, oh my God, that's so strange. What are, you know, the compare and contrast question?
I, so I think in the context of what an investor worries about and some of the stuff that comes up, there's that overarching political concern that somebody's going to take my assets away from me, because assets outside of the United States are not real property interests. In the United States, owning that asset, owning that working interest in those minerals is a real property interest. And it's severable from the property. That concept doesn't exist outside of the United States. And so people get really concerned that the Nigerian government is going to suddenly swoop in and take away the licenses of people that are out of out of favor with them. Um, so you go through a lot of conversations. I think back to the different investment committees that I've sat in and the questions that you get asked. There's always tons of concern around, are they going to take our assets away from us? Because that's our collateral, that's our security. And it's, when you look at game theory, it's absolutely contrary to what's in the interest of Nigeria. The last thing they want to do is take that away, because that is their revenue stream. Other things that strike me as being, and it's probably, I guess you probably see some of this in the United States, but if you're looking at investments where the export route is through another country, then it just wildly complicates the picture, because people get concerned. And we actually were faced with an issue where we were exporting gas out of, and I won't get too much into the weeds on it, but we were financing the development of a gas field where the gas was being exported from one country to another country that was obviously different. And there was leakage. Basically, when it crossed the border, there was a toll, there was a fee being charged, and we couldn't figure out. We were monitoring it. It'd been up and running for a couple of years, and we were looking at where's the cash going. And it turns out that there was a company that was being paid, which was essentially a shell company, and that shell company was presumably owned by the president's daughter. And the president's daughter actually turned out to live literally a couple of miles away from our office in Geneva. And she had bought the most expensive house that had ever been purchased on the lakeshore, and she'd filled it with a bunch of her country's artifacts, their archaeological artifacts. And all of this was from the gas flows that we were financing out of her country and into another country. So there's things like that. I think it's similar types of challenges and risks and uncertainties that you have in the United States, but they're just magnified or amplified by political issues.
Yeah, and quite frankly, I'm not sure that's that different than the state of California. If I've made everyone I know, and now that we're best friends, I'm going to make you take the pledge. If I ever buy another oil and gas asset in California, you have the right to just come kick me in the balls and knock me over and kick me as much as you want. I will testify in front of the judge. No, I told Paul to do that. But
which one burned your fingers?
So we wound up making a lot of money when we bought the La Brea field, kind of the tar pit around LAX. Whenever you fly in and you head over into Hollywood, you drive right through the La Brea tar pits. And this was the craziest thing, because we bought these assets, and the first thing our CEO wanted to do was send a vacuum truck out to just clean up all the oil on the ground. And the lawyers are like, no, you can't do that. And we're like, what do you mean? And they go, then you're acknowledging that you actually caused the oil there as opposed to natural seepage. So literally we just had to leave oil on the ground, which was bizarre. But then what was it? Oh, and then we bought Kettleman Dome, which is in Chevron had the Kettleman field that produced a TCF. And then you came over and then there was this little dome. And it was the craziest thing, in that back in the 30s, they had drilled 3 wells to the Kragenhagen formation that literally were producing, call it 25 barrels a day, 70 some odd years later, right? And if you look at the total production, one well had done, 500, 600,000 barrels. Another one had done 400,000. Another one had done 400,000. And they drilled these open hole. And so So you're sitting there going, okay, how hard could it be? I get drilling to 10,000 feet is not what Californians do, but we're Texans, right? We can go do this. We spent so much money and we couldn't get a drop of oil to come out of that. And then this is not the Chuck Yates podcast, but unfortunately we're going through California. Then we bought a steam flood in Santa Barbara County. And believe it or not, we got it permitted. So we actually got the
Wow.
big risk was government risk. We got that done. And with the steam flood was actually starting to work as advertised. It's just oil prices collapsed. And it probably needed 80 and we were in a world of 40. So
Yeah, that'll burn your fingers.
yeah, this gray hair that you see, that's all California. So yeah.
Oh man, it always looks good on paper. California looks like a drain in so many different ways.
I mean, the third most prolific oil basin in America. I mean, they've got, Beverly Hills High School has a well right on campus and all, but yeah, just a mess out there politically. So what were we fighting about or not fighting about
We weren't, yeah. I think we agreed.
Yeah, no, because I think what the tweet I sent was the natural gas guys need to be selling electrons instead of selling natural gas, and
But it's exactly what you had said. And the one line I want to highlight that you sent in your message was that the natural gas guys need to be more like the Michelin rating guide. That was awesome.
Well, and I think just kind of level set. I've talked about this on BDE and I've tweeted about it, and I've talked a little bit about it on Chuck Yates Needs a Job. But when you look out, all of the growth in power demand in the United States is going to come from some sort of tech company. It's AI, it's data centers.
Yeah.
And what I worry in my anecdotal talking to those folks, like I've got a friend, he came on the podcast that's head of AI for Intel. They're all choosing nukes. I mean, they talk openly about it, and you see all the joint. And I just worry that the natural gas folks are sitting there saying, well, they're going to need power demand by natural gas. And they're looking through the lens of being an energy company as opposed to what tech can actually do with nukes if they want to throw money at it and their political might. So I think that was kind of the point of my text or my tweet.
And I mean, right back to your Michelin guide, and this resonated with me because when you talked about the Michelin guide, and just to put that out there, essentially a tire company incentivizing people to go drive their car more and go to restaurants. And that's kind of the same way. What can natural gas do to incentivize tech companies of all different shapes and sizes to use natural gas, or to at least consider natural gas in the spectrum of different sources of power? The reason it resonates is because if you look at the history of where I've been working up until the last 2 years, it's been in places where everything is stranded, not just gas. Everything is stranded. And oil is a lot more portable, but anything that's even remotely gassy or natural gas liquid, it has to find a domestic market. And that domestic market is not, a lot of times it's not, it doesn't exist. So you got to come up with a way to create it. Russians did it by putting things like plastic companies in Western Siberia. Makes a hell of a lot of sense. They're going to consume the gas to create plastics. The plastics are a lot more exportable. They're a lot easier to move around. And they end up selling a whole bunch of plastic to China. And it's a fantastic business model. So, why can't you take something that's very similar to that and lift it up and put it into West Texas, where gas is also stranded and struggling because of Waha and negative prices, and find a consumer in tech? And I think, the reason it really resonated with me is because if I go back and look at what I do as a hobby, I absolutely get nuts about digging into how companies work. It's just, it makes me smile. And so I've gone through companies like Peloton during COVID because it suddenly was a bubble, and I wondered, what the heck's Peloton? And so how's it work? I did the same thing with Apple, NVIDIA, to just kind of get a feeling for how these companies work. And Google, Apple, Amazon, et cetera, as a group, those companies now, Google is the largest purchaser, the largest consumer of electricity in the United States. That's staggering when you think about it. The United States has a pretty big steel industry, and most of the United States steel industry is electric arc furnaces, electric being the key word. Google's using more electricity than all of the steel companies in the United States. And if you look at the total amount of energy being consumed by data centers in 2023, it just about met, and it's not quite exceeded, the total amount of energy consumption, including both electricity and the coking coal that the steel industry in the United States consumes. It's just a tremendous scale. So all of that got me really excited when I read that. I thought that's a fresh way of looking outside of what we normally do in oil and gas. What we normally do is just sell it to Plains All American, or just sell it to Vitol and be done. Coming up with a concept of, well, we don't have to sell to Plains, do we? Can we pick up the phone and call Google and see if Google would be interested in this? It is absolutely a viable conversation. So that's why I was really excited about coming on the podcast, man.
Well, and kind of where we were going in our direct messages is you can look at it two ways. I'm a little cynical and jaded, and they're like, no, natural gas has to do this. They have to reach out to tech, because if they don't, nukes are going to take over. The flip side, if I wanted to be more positive, is, hey, this is a tremendous opportunity. But I really do think the Toby Rices of this world need to come together as a group and go sit down straight with Google and the like and make their pitch about how good natural gas is and take along a solution, whether that is they've partnered with somebody or they're going to show up with generators. That's way above my pay grade. But I think we have to do that.
I think there's so many different reasons we should have already done it, and there's no reason we shouldn't do it. And I mean, looking at Toby Rice is a great candidate. I've met Toby. I know that you and him are friends. He's a charismatic and hyper intelligent individual, and perfectly suited to be the face of Silicon Valley for oil and gas. And it more fundamentally, or more in terms of just what he has with regard to firepower, EQT, they're AA rated in terms of their ESG rating by MSCI. How many people at Google, if you asked them what they thought the ESG rating of an oil and gas company, would guess AA? I guarantee the number is zero. So going out there and waving that flag, not necessarily waving the flag that's, you have to have this energy. This energy is something that's critical for your industry, because I think that's probably not going to necessarily take the horse to water. But going out there and changing the rhetoric and controlling the narrative a little bit ourselves, and advertising that we are a very clean industry. And yes, we have an impact on the environment that's different than Google, but without necessarily turning it in their face, Google is the largest consumer of electricity. You tell me that you think they're not consuming some electricity that's generated by coal? I guarantee you they are. So, I think there has to be an intelligent, measured conversation.
And I think, at the risk of beating a dead horse, I do think that everybody in the energy business sits there and says, oh, well, permitting is going to be so bad and it's going to take such a long time to build and all. I always say that's looking through our lenses as energy companies. Tech has no problem getting what they want out of DC, and
exactly.
they throw money at things and make shit happen quick. Yeah, they do.
Google in 2013, if I'm not mistaken, which I might be, they became FERC regulated to be a wholesale energy consumer. So, in terms of Diamondback going out and getting a FERC license to sell wholesale, why not? That it's absolutely within the context of possible. You just got to ask. I'm sure there are challenges, but that's our job is challenging and being successful at creating new demand for gas is not a walk in the park. Otherwise, gas prices would be $5 an MCF. The reason they are where they're at is because that work hadn't been done, and it's certainly within the realm of graspable. And I think there's companies out there that are well positioned as sort of an intermediator, if you like, in terms of like Landbridge is a good example, and the position they took on the Texas-New Mexico border. And they're specifically, with 5 points behind them, proposing or claiming that they've got data centers that are going to be showing up in West Texas. That's a great first mover. It's a great way to break the ice. I think it's a good way to prove a concept.
Yeah, if I was the mayor of Monahans, Texas, I'd be out in Silicon Valley talking about how great it is and that Bennigan's really is luxury dining. And maybe we can do something to upscale it. Because the other thing I think that kind of comes out of this is I just don't believe the existing grid is going to be able to grow, adapt to be able to power this. I truly think the monopolistic utilities are almost going to have to, you're almost going to have to just take the hostage out of the situation, to quote Keanu Reeves. But
I think, one of the things that is an opportunity for oil and gas people is to go out to Silicon Valley and ask questions first and listen. Really listen to what Silicon Valley are trying to achieve. Don't go out there and tell them you need to buy natural gas, because that's, I think, the quickest way to end the conversation. Go out there and say, what are you guys trying to achieve? If you look at what Google and Amazon and Microsoft and Apple have been doing, they've been signing long-term power purchase agreements with renewable providers, but then they tap themselves into the grid. They tap themselves into the grid because of a couple of different reasons. And it's stuff that you probably are already thinking of. It's stuff like, what happens if this project gets canceled? If you look at what happened with the wind projects off the northeast coast of the United States, a couple of them got canceled, and the power purchase agreements that were associated with those also got canceled. So if you're already tapped into the grid, your data center project timeline doesn't get knocked off by your wind project that Ørsted was sponsoring falling over. The other reason that they tap into the grid is because these are long-term contracts. They're usually doing fixed price, and they're usually doing them for 10 to 15 years. I think it's a question we need to, as an industry, to ask if that's how they continue to want to structure their projects and plan their data centers. Then it's a question we need to ask ourselves. Are we prepared to sell fixed price for 10 or 15 years? That starts looking like a VPP. Is that what our investors want? And is that something that within the mix of our total revenue streams, can it be balanced to where it does meet our investors' objectives? And I think as well, I've heard a lot of people push back when I've talked to them about VPPs, or talked to them about hedging, or talked to them about just holding more cash and not dividending out all of your cash every single quarter. And the pushback I get from a lot of the management teams is, well, that's what the investors ask for. I think if you really sit and ask yourself honestly, the way that you're suggesting the energy industry might need to do, sit down and ask yourself, should I push back on my investors and tell them that, having fixed prices for a slug of our gas is a good thing. It makes us more sustainable. It makes us more durable. We don't have to go through negative gas prices at Waha. We may not get the $15 gas when it spikes, but I can guarantee you $15 gas disappears faster than it appears. So,
Yeah.
you know,
Now that's a really good point, because my take on investors has been, we in effect lied to them in terms of saying, well, we're drilling 40% rate of return wells. And even a 27-year-old who's not incredibly fluent in the industry can sit there and say, well, why did PDP PV10 not go up then? You know,
yeah.
that 10's a lot less than 40. And if you're drilling 40,
Where's the rest of the money going?
where are the rest? Yeah. So I think that was an issue. I do think, when we bungled up spacing, and it just took a while to kind of figure that out. And then I don't know that an investor truly has enough in the way of information. They get one reserve report a year. It's done at, the average price for the year. No sensitivities to that. I mean, I don't want to say that we should be publishing daily production from every well you have in a company, but there ought to be more so that you can have independent eyes on a reserve report and get a better idea. Because right now, I mean, the reason they want cash flow, they want dividends and buybacks, et cetera, is they're basically saying, I'm willing to give you 3 to 5 years of cash flow, period.
That's it.
That's all I can get my head around.
Yeah, it's absolutely right. And, can our industry plan much further out than that? And I think there is a pushback in the sense that if I'm dividending out all my cash and prices go down, of course my 3 to 5 year plan is going to come unhinged. We need to think around that and how holding a bit more cash might be healthy for us and not dividending it all out. And holding a little bit more cash also provides you with a little bit of a war chest. When prices do go down, you could potentially be taking advantage of other people who were not thinking through the cycle. But I going back to how well we're adapted or fit to the tech industry, I do think there's tremendous opportunity to go sit down and ask questions and engage with a market that we've never engaged with before. And I guess, to that, you'll know a lot better than I do. How much do a lot of the independent oil and gas companies engage with the market further than just engaging with a marketing company, somebody who's selling their gas or selling their oil for them? It never hurts to go have those conversations, and you always learn something. And it may not be, I think one of the reluctances is when you're doing that, you're kind of taking on a role of being a salesman. And I've sold stuff in my past when I was in high school and college, and you got to knock on a lot of doors and have a lot of doors either stay shut or be shut in your face before you get one sale successful. And that's hard work. It's not fun.
Yeah, it's interesting you say that, because I think at other times when I've tweeted out my, hey, natty boys, you got to be selling electrons, not natural gas stuff, more than once there's been the mention of, if Aubrey were still around, Aubrey would be running around Silicon Valley right now, convincing these guys that, hey, we're the wave of the future. You should be on board with us. I have heard that several of the private companies like Hillcorp have hired some of these old IPP, independent power producer guys that were building all the projects back in the 90s.
Yeah.
They've hired some of that type talent to at least start exploring this notion.
It makes a lot of sense, doesn't it, for a private company, because it's one or two people who are deciding whether or not that fits their risk appetite and what they want an oil and gas company to do for them. If you look at the ownership of a lot of the public companies, it's 40% BlackRock or 40% of a couple of different BlackRock entities, 20% Vanguard. it's kind of hard to get your head around what your investors really want you to be, other than a proxy to what oil and gas price is doing. And I think getting away from that and seeing ourselves as businesses rather than a proxy to oil and gas price, to just another indice to WTI or Henry Hub, is a great first step. And going out to Silicon Valley and presenting yourself as a business and a business partner with Google or Apple certainly empowers you and puts you in that position where you do feel like, wait a minute, I'm out here seeing it through the entire value chain. I'm a business that is having a direct impact on one consumer, and that changes the dynamic. It's a lot more satisfying than just selling to planes, I would imagine. No offense to
Yeah.
planes.
Well, yeah, and I guess note of full disclosure, arguably my second largest investment in the Yates family portfolio is Plains All American.
Okay.
We'd just done a bunch of, no, you can fire away. We'd done a bunch of stuff with them at Kane Anderson. So I wound up with a bunch of
Yeah.
PAA stock. Um, this was interesting when I got fired and was sitting around doing nothing because I was taking COVID very seriously because the kids were going back and forth between me and my ex-wife, and she had um, asthma. And early
Oh,
days of
yeah.
early days of COVID, you didn't know if asthma was a comorbidity. It turned out that shooting albuterol in your mouth twice a day killed COVID. So it was actually really good for COVID. But so I was kind of out there by myself in Richmond, Texas. I wrote an S1 for an entity called True Tracker, and what it did is it basically was a better mousetrap on USO. I don't know if you've
Okay.
ever messed
Yeah.
around with USO, but it just has that's the in effect proxy for oil price. Basically buys it's not an ETF, but it's an ETF that basically buys the front month, the WTI contract, and tries to track oil price. And because of the roll, et cetera, just is a horrible product. But there's $3 billion worth of shareholders in it. And I came up with the better mousetrap on how to do it. We were basically doing it through an old fashioned royalty trust. We were going to distribute the cash at the end of the holding period. That way it could be arbitraged by traders and thus have to track.
Interesting.
So I draft this S1 and just typical Chuck Yates arrogance. I'm not going to get any investment bank involved because I don't want them stealing my ideas. So I hired Latham Watkins and Kirkland Ellis, and we just drafted this beautiful S1. I go around to all the investment banks, and the question was, well, will any institutions own this? And I had to say, I don't know. I do think we can make the case of, hey, why are you buying, no offense to Case, but why are you buying Diamondback? You just need a proxy for oil price, and this is a good one, and you can't trade commodities. And so
Yeah.
I had that whole case, and I said, but clearly you can birth this through your retail network. Somebody wants to take a bet on oil price. And every corporate finance department loved it. And then they would go over to the crusty old guy that ran the retail department of all these investment banks, and they go, you're bringing me a flow through entity in the energy business? Screw you. I lost
Get
so
it
much
out.
money off your MLP. Get the hell out of it. So anyway, I have a nice S1 if you ever want to read it.
How are you doing that? Was that through physical contracts, or were you doing financial contracts?
So it was financial contracts.
Okay.
And basically what we were going to do is prepay for a swap. And because
Okay.
if you think about it, what's the most quoted thing out there? It's somebody wants to hedge, right? And you call up
Yep.
Jay Aaron or whoever, and you're like, okay, what's these 24, and they'll quote you a price, right?
Yep.
So anyway, I was just taking the other side of that. We were going to prepay. We are going to go raise money, almost like a SPAC, raise money,
Interesting.
prepay for the swap, and we were in effect creating Dees 24. So we did it over the 30 days, like, because Dees
Yep.
24 is basically a third of November and two-thirds December. And then when the swap paid off, we were going to just distribute the cash. And so that way, all these banks that every day quote, Dees 24 to all these oil and gas companies, this unit that would trade out on the NASDAQ would have to be the same price because you could arbitrage it. I mean, you
Yep.
could, yeah. And so I thought that way it would track and kind of the market would be, hey, you want to take a bet on oil price over the next year, going to be higher or lower. And anyway, I thought it was a great product.
That's a really clever idea, and it addresses the weakness of the the more popular product, which they ended up having to sell a whole bunch of contracts when COVID happened, and that's why they ended up. If I understood it correctly, that's one of the key drivers to why WTI went negative.
Yeah, no, that's exactly right. And they got sued and they had to go
Yeah,
further out on the curve than they wanted. And so yeah, no, I thought it was really smart, but
good
couldn't
mousetrap, man.
couldn't couldn't get it done. They had some tax losses though. So.
Well, and speaking of investment banks, that's a really interesting sort of spin or pivot back over to the natural gas and tech companies. I think one of the concerns a tech company would have is a sole provider, single source. And depending on how big you are, if you're Diamondback and you can demonstrate that you've got 15 years of stable gas production, I think even Diamondback would probably have a hard time convincing people of that. And that's where investment banks can be incredibly useful. Although I kind of have a hard time seeing investment banks that are really doing that today. And when I say seeing them, I'm putting my finger on an investment bank like a Wells Fargo or JPM or Goldman Sachs. I know they're trading a whole bunch of gas. I don't know how much they're intermediating or sleeving between companies that have a credit risk profile that the buyer doesn't necessarily want to face.
Yeah, that's a really good point that I hadn't thought through on all this, and maybe there's something in the end up. Maybe it's even a coalition. It's Toby et al. That
Yeah.
goes to Silicon Valley, and it's hey, where do you want a data center? Oh, we got the pipeline X there. We're going to be able to provide this for you. So it's not necessarily just solely Diamondback's gas. But that's a really good point. I hadn't thought of that.
But I guess, it's kind of like the big mineral cos, or the big non-op cos that have 10 different investment grade operators across their entire position, their entire portfolio. And that ends up giving them either a better rating themselves or the ability to go out and sell something like an ABS if they want to sell an ABS to try and lever it. Same thing would go if you're trying to sell gas to Google. It'd be great if it looked an awful lot like an ABS, but it was a physical, and I guess, a lot of ABS is physical, but, you're basically saying, all right, we've come together as a coalition. If you need a Goldman Sachs, although I think Goldman Sachs would potentially take a disproportionate share of the
They're pretty proud that way.
yeah. maybe there's other banks out there, or maybe just a coalition that was structured the right way in terms of putting it into a royalty type of a structure. I don't
Or
know.
maybe even kind of like how you were talking about, we're going to have this renewable project, but we're connected to the grid. Maybe
Yeah.
maybe that's hey, we're going to build your data center off this field. No, by the way, there's the XYZ pipeline that
Well,
runs here.
there's the two of the largest data centers being built globally are being built outside of Dallas right now, of all places. And it's because of that wind farm that's outside of Dallas, somewhere towards Abilene, which is great. And, I think I'm not knocking wind, and I'm not knocking the data centers plan or their idea. However, anybody and everybody agrees that wind has to have some sort of a base load. It has to. And wind isn't there 24/7. Data centers need it 24/7. Batteries are viable, but batteries would end up being a potential risk, especially during a cold Abilene winter. Things like a gas fired turbine that's there and it's running the base load constantly and providing you something that looks like nuclear power would be fantastic. I think for me, that's an absolute enhancement in terms of project risk and sustainability of the project. And it's a heck of a lot better if you can point to it and say, I know it's natural gas. I know it was produced cleanly and safely in the United States. It's not coal that's coming from somewhere else and firing the grid. And we're not necessarily able to put our finger on the electron and say that's a clean electron. So that's kind of my thought around a fallback position. I think the first position to go out and talk to data centers around is we want to be the sole provider of electricity because we're clean and we're stable and we're reliable and we're also affordable. The fallback position is obviously, well, if you want to pair us with a renewable project, that's great. In terms of the nuclear, which we haven't really addressed, but I wanted to go back to that and just make a couple of comments. I mean, one, everybody talks about project lead time for setting up, whether it's an SMR, whether it's a full-scale, full-blown nuclear plant. The thing that we don't talk about very much is fuel and where the fuel is coming from. Uranium, 60% of the world's uranium comes from Kazakhstan. It's not a bad thing, but it is a risk when it comes to energy security. 40% of the world's refined or enriched uranium, which is what you need to be able to produce nuclear power, comes from Russia. And that is a problem for us right now. And it's been such a problem that they passed a law in August, which said we can no longer import enriched uranium from Russia. But they passed it with the ability to have a waiver. We're in September right now, and in the first month, they've already provided a waiver through 2026 to be able to import enriched uranium from Russia. It's a real problem. The United States doesn't have the infrastructure for the full value chain of nuclear. We can build a nuclear, you can build an SMR, although there has not been one built and put into commercial operation as of yet. So it's still an untested idea. So there is some degree of proof of concept risk that's still there. But then even if you get the thing built and up and running, where are you getting the fuel from? And with natural gas, it's great. It's right there. It's in West Texas. It's part of the United States, the American economy, and that's agnostic to Republican or Democrat.
Yeah, no, that's interesting. That's a good point. Because when you think of where are other places for uranium that are safe for the Western world, it feels like it's in a bunch of places that are going to be not my backyard.
Well, it's not my backyard, but the biggest reserves in the world, interestingly, are in a very friendly country. But I'm not sure, and you'll be able to tell me more about this because you were there recently. The largest uranium reserves in the world are Australia.
Yeah. And that's where I was going with. They do a lot of mining there, but but there's still. I mean, it wasn't that long ago. They had a ban on fracking, in Australia. So it's I'm all for Sheffield and hoping he gets the Beetaloo Basin up and producing gas, but. That's exactly who I was referring to when I was like, "Hey, not my backyard." Did you start throwing nukes? What was the name of the Australian band that sang Midnight Oil?
Midnight Oil.
The lead singer of Midnight Oil ran for prime minister like 30 years ago on the No Nukes platform and got 4% of the vote. So it's still got. Well, Paul, this has been fascinating. This has been fun.
It's been really interesting, Chuck. I really appreciate it, man.
Yeah, no, it's always wild when so I was in New York. I shouldn't now I can't say the joke. I don't know that. Anyway, some of the anonymous names out there on Twitter I'll randomly meet up with a drink wherever, and my girlfriend's always just mortified. Oh my God, Slaughterhead, you're going to go meet somebody named Slaughterhead and you don't know who they are. I was like, so it is fun being
Yeah.
able to meet people on Twitter, and particularly people from Geneva, Switzerland. So,
Well, man, mom and dad still live up in the Woodlands, so next time I'm home, I'll
were
drop
you
you a
a
line.
were you a Woodlands high school, or did you go to John Cooper?
I went to John Cooper for 1 year in sixth grade.
Okay,
And then I was at McCullough, which was the high school in the Woodlands up until my senior year in 1997. And then 1997, we all switched over to the Woodlands High School first year, inaugural year. We were the first graduating class.
nice,
So yeah, and
nice.
then
So,
but I was
I
going
was
to say,
gonna,
then I went from a class of 900 kids in the Woodlands to a class of 19 in petroleum engineering at the University of Texas.
oh shit, that's
It
crazy.
was not popular, man.
Well, do you want people reaching out to you? And if so, how best for them to find you?
Absolutely. People can find me on LinkedIn, they can find me on Twitter, or they can look at my website. I can provide it all, or they can reach
Yeah,
me
just
at,
fire
go ahead.
fire away on all those names, and we'll have Jacob post the graphics on it too.
Great. So the name of my company is CounterPoint Analytix, and the web address is www.cpanalytics.com. And my email address, you can find it on the website. And then my LinkedIn, you can find me under Paul Clark at Counterpoint Analytics.
Cool. Well, I appreciate you coming on. This has been fun.
It's been a great time, man. Looking forward to staying in touch and hope you have a great afternoon.
Yeah, likewise.